All right, let's jump right in, shall we? Get ready to take a trip back to the 1980s for today's deep dive.
Big hair, shoulder pads,
Oh, yeah, all that.
power suits, the whole deal.
Absolutely, but we're not here for a fashion history lesson.
No,
We're diving into the world of high-stakes finance.
that's right.
Specifically, a 1998 paper by Andrade and Kaplan that really makes you rethink what it means for a company to be in trouble.
Yeah, this paper it really kind of flips the script on how we think about companies in distress.
Okay, so give us the lowdown.
We're looking at highly leveraged transactions.
HLTs.
HLTs, think big buyouts or recapitalizations, companies taking on massive amounts of debt.
Got it, so companies swimming in debt.
Yeah,
But the title of the paper is a mouthful. How costly is financial, not economic distress? Evidence from highly leveraged transactions that became distressed?
right.
What's the difference between financial distress and economic distress?
That's the key question here.
Yeah, isn't being unable to pay your bills just bad news, period?
You'd think so, right? But picture this. Imagine a company that makes the hottest new gadget. Let's say it's a widget.
Okay, the most sought-after widget.
They're selling like crazy. Profit margins are through the roof. But they borrowed a ton of money to get to this point, and now those loan payments, they're eating them alive, even though the widget itself is a huge success.
Ah, so they're widget rich but cash poor.
Exactly.
Like someone with a closet full of designer clothes but an overdrawn bank account.
You got it.
So why focus on the 1980s? What's so special about that era in the context of HLTs?
Well, the 80s, they were a wild time for HLTs. I mean, a huge wave of leveraged buyouts and recapitalizations fueled by this idea that debt could be a good thing.
Really?
Yeah, it was thought that debt could discipline managers
Interesting.
and unlock hidden value in a company.
Kind of like the idea that having a mortgage makes you more responsible with your money.
Exactly.
Makes sense.
But, like any trend, there were bound to be some hiccups along the way, and many of these HLTs ended up defaulting, unable to keep up with those big interest payments.
And back then, default was basically seen as a death sentence for a company, right?
Pretty much, yeah.
Which is what makes this research so fascinating.
For sure.
They're asking, can a company be in financial distress, struggling with debt, without its core business actually being in trouble?
Right.
And if so, what does that kind of trouble look like in the real world? What are the implications?
That's what Andrade and Kaplan set out to uncover.
Okay, so how did they go about answering this question? What was their approach?
Well, they didn't just look at the moment when these HLTs hit a snag. They tracked them all the way through, to the resolution of their financial distress.
So whether it was through Chapter 11 bankruptcy or a sale or restructuring of some sort?
Exactly. They followed the whole story, not just the opening act.
Okay, so what did they discover? Was it all doom and gloom like everyone assumed back then?
Actually, get this. On average, these companies, they did not lose value over this entire period.
Wait, really?
They may have even gained a little.
Hold on. You're telling me that even though these companies were drowning in debt, they didn't necessarily go bankrupt and lose everything?
Nope.
That seems counterintuitive, to say the least.
It is. It really challenges the assumption that any financial distress automatically equals a company's demise.
Right, because these companies weren't failing because they were making bad products or losing customers.
Right.
Their core businesses were often doing quite well. Their problem was the leverage, right?
Exactly. Too much debt relative to their cash flow.
Okay, I'm starting to see the distinction.
But
But how did the researchers actually prove that the distress was primarily caused by this high leverage and not some underlying weakness in the company itself or in its industry? I mean, couldn't it be that the businesses were just struggling and they had too much debt on top of that?
That's a great question.
Yeah.
And the researchers were very careful to address that. They looked at a company's operating margin.
Okay, and remind us, what does operating margin tell us?
Operating margin basically tells you how much profit a company makes on each dollar of sales.
Okay, got it.
And guess what? In the year these companies became distressed, they still had positive operating margins.
So even with all that debt hanging over their heads, they were still making money.
They were.
Wow, that really highlights that this was more of a financial structure issue
Yes.
than a problem with their fundamental ability to generate profits.
Right.
But come on, being in financial distress has to have some kind of cost, right?
Hmm.
Even if it's not a death sentence, surely there are downsides to being in that kind of financial pressure cooker.
You're absolutely right. Distress isn't free.
So what did they find?
Well, that's what we'll be digging into next. The researchers found that the costs of financial distress are more nuanced than you might think.
Okay, I'm intrigued.
They looked at how these companies performed operationally, how their value changed, and what specific actions they took to deal with their debt burdens.
All right, so let's take a break and then we'll unpack all of that in part 2 of our deep dive.
Sounds good.
Welcome back to our deep dive into the sometimes surprising world of financial distress.
It's really fascinating stuff when you start peeling back the layers and you see what's really going on beneath the surface.
Right, we've debunked some myths along the way.
Definitely.
And discovered that even companies drowning in debt, they don't always sink, especially if their core business is strong.
Yeah, it's all about the context, like we've been saying, and understanding the nuances.
Absolutely. But let's get down to brass tacks here. You mentioned that the researchers, Andrade and Kaplan, they actually went a step further and identified specific actions that these companies took to deal with their debt burdens.
Yeah.
Things like cutting investments, selling assets at fire sale prices,
Right.
and even just delaying the inevitable. Can you unpack those a little bit more for us?
Sure, these are what we call the qualitative costs of financial distress.
Okay.
They're not always, captured in the numbers, but they can have a really big impact on a company's long-term success. And what's really interesting is that Andrade and Kaplan found that these costs were often concentrated in the period before a company filed for Chapter 11 bankruptcy.
Hold on, I need a quick refresher. How many of these 31 HLTs that we've been discussing, how many of them actually ended up in bankruptcy court?
19 of them ultimately filed for Chapter 11.
Okay, so a significant number.
Yeah, but here's the surprising part. The research suggests that a lot of the paying, those tough decisions like, slashing investments or selling off valuable assets, that happened before they filed.
So the lead up to bankruptcy was often more chaotic and more costly
It seems that way.
than the actual bankruptcy process itself.
Yeah.
Huh, that's not what I would have expected at all.
It's kind of a common misconception that Chapter 11 is this Wild West, unpredictable free-for-all where everyone just loses control. But in reality, it often provides a more structured, predictable environment for dealing with financial distress.
So it's not this chaotic free fall that a lot of people imagine. Instead, Chapter 11 actually introduces some rules and some order into the situation.
Exactly.
Okay.
It gives companies some breathing room, to renegotiate with creditors, come up with a plan to restructure their debt, and hopefully emerge from the process in a stronger position.
That makes sense, but if Chapter 11 isn't this boogeyman we often make it out to be, why were these companies so hesitant to go there in the first place?
Well, there's still a lot of stigma attached to bankruptcy.
Yeah.
Even though it can be a really valuable tool, a lot of companies still see it as this sign of failure.
Right. Something to be avoided at all costs.
Yeah, the dreaded B word. It's like admitting defeat.
But wouldn't it sometimes be better to just rip off the Band-Aid, face the music sooner rather than later, especially if those pre-bankruptcy maneuvers are so costly?
Well, it's a tough call. There's always that hope that things will turn around,
Right.
that a miracle will happen, and they can avoid bankruptcy altogether. But as we've seen, that delay often comes with a hefty price tag.
It's that classic dilemma, isn't it? Fear of the unknown versus the potential pain of just taking decisive action.
Right, and sometimes the fear wins out, even if it's not the most rational choice.
Human nature. Right.
Exactly.
So regardless of whether they filed for Chapter 11 or not, these companies, they had to take some sort of action to deal with their debt burdens.
Right.
So let's break down some of those qualitative costs that you mentioned.
Okay.
Starting with investment cuts, you said that almost all of the companies in the study, they had to scale back their investments.
Almost all of them, yeah.
And for about half of them, that actually meant missing out on potentially really profitable opportunities.
That's right.
So they're tightening their belts, but it comes at a cost.
It does.
Sometimes sacrificing future growth potential.
Yeah, it's like having to choose between paying rent
Right.
and investing in your education. Tough choices.
And what about those fire sales? That sounds pretty dramatic.
It can be, yeah. About a third of the companies were forced to sell off assets very quickly, often at prices that were well below what they would have gotten if they had more time.
So it's like having to sell your house for half its value just because you need cash now.
Exactly. You're selling low because you're desperate.
Right. And no wonder that was so costly for these companies.
Yeah.
And then, of course, there were the delay tactics.
Right. Kicking the can down the road.
Crossing your fingers, hoping for the best.
Hoping something will magically change.
It's like ignoring a toothache, hoping it will just go away on its own.
You might get some temporary relief, but eventually you're going to have to face the dentist.
Yeah, the pain's just going to get worse.
That's right.
So same principle in the financial world, right?
Absolutely.
Delaying the inevitable can actually lead to greater costs down the road.
Right.
This has been a really, really eye-opening deep dive.
I agree.
We've learned so much about financial distress, the causes, the consequences, even some potential silver linings that we might not have expected.
Yeah, I think the biggest takeaway for me is that it's not always the disaster that we imagine it to be.
Exactly. It's all about looking beyond the headlines and understanding the nuances.
For sure.
Financial distress is complex.
It is.
And there's no one-size-fits-all answer.
Yeah.
Which actually leads me to a question that I've had throughout this deep dive, this research that we've been discussing. It focused specifically on those HLTs from the 1980s.
Right.
A very specific time period.
Yeah.
With its own unique set of rules and economic conditions. So would we find the same things today?
That's the million-dollar question, isn't it?
It is. It really is. And I think that's part of the beauty of doing a deep dive like this. We don't just walk away with the answers.
Right.
We walk away with new questions, a deeper curiosity, and a desire to keep learning and exploring.
I love that.
So keep exploring, keep questioning, and keep those minds engaged. Until next time.
See you then.
Welcome back to our deep dive. We've been exploring the fascinating world of financial distress.
You know, it's really not as straightforward as you might think.
Right. We've been debunking some myths along the way and
A few surprises, I'd say.
Absolutely. Like the fact that companies drowning in debt, they don't always go under.
Especially like we've been saying, if that core business is solid.
Exactly. It's all about context and nuance.
For sure.
But let's get back to those specific actions companies take when they're grappling with those debt burdens. You mentioned things like cutting investments, selling assets at those fire sale prices.
Right. And we can't forget about those delay tactics, kicking that can down the road.
Right. Hoping for a miracle.
Sometimes it works, but
sometimes it doesn't.
Often it doesn't.
So walk us through these a little bit more. What did the researchers find?
Well, they call these the qualitative costs of financial distress.
Okay.
Because they're not always easy to see in the numbers, but they can have a real impact on a company's future.
I can imagine. So what were some of the key takeaways about these qualitative costs?
Well, one of the most interesting findings was that these costs were often concentrated in the period before a company actually filed for Chapter 11 bankruptcy.
Interesting. Now, how many of those 31 HLTs that we've been talking about, how many of them actually went the Chapter 11 route?
19 of them ended up filing.
Okay, so a pretty significant portion.
Yeah, but here's the thing. The research suggests that a lot of the tough decisions, the ones that really hurt, like those big investment cuts or having to sell off valuable assets at a loss, those often happen before they filed.
So it's almost like the lead up to bankruptcy is more tumultuous.
It seems that way.
Than the actual bankruptcy process itself.
Yeah, it's counterintuitive, right?
It is, because a lot of people think about Chapter 11 as this really chaotic, unpredictable situation.
Right, like a free-for-all.
Yeah, but it sounds like it's actually more structured than that.
It can be. It often provides a more predictable environment for companies to actually deal with their financial problems.
Okay, so it's not this uncontrolled downward spiral.
Not necessarily.
Instead, Chapter 11 kind of introduces some rules, some order.
Exactly. It can give companies some breathing room to figure things out,
Yeah.
Renegotiate with their lenders, come up with a plan to restructure their debt, and hopefully come out on the other side in better shape.
That makes sense, but if Chapter 11 isn't this big, scary monster that we often think it is, why were these companies so reluctant to go there in the first place?
Well, there's still a stigma,
Yeah.
Even though it can be a helpful tool, it's often seen as a sign of failure.
Right, like admitting defeat.
The dreaded B word.
Exactly. But wouldn't it be better in some cases to just rip off the Band-Aid, address the problem head on, especially if those pre-bankruptcy maneuvers are so costly?
You would think so, but there's always that hope that things will turn around.
Right, that a miracle will happen.
Exactly, and they can avoid bankruptcy altogether.
It's that classic dilemma, isn't it? The fear of the unknown versus the pain of potentially making a tough decision.
And sometimes that fear wins out, even if it's not the best choice logically.
So it sounds like human nature is at play here as much as anything else.
Absolutely.
So regardless of whether they went the Chapter 11 route or not, these companies still had to deal with their debt.
They did.
Let's break down those specific qualitative costs that you talked about, those actions they took. Starting with investment cuts, you mentioned that almost all the companies had to scale back.
Almost all of them, yeah. And for about half, that meant having to pass up potentially profitable opportunities.
So it's like tightening your belt, but sometimes to the point where it really hurts your future potential.
Like choosing between paying the rent and investing in your education. Not an easy choice.
No, not at all. And then there were those fire sales.
Right. About a third of the companies had to sell off assets really quickly, often for much less than they were worth.
So basically selling at a loss because they're desperate for cash?
Exactly, like having to sell your house for half its value just to make ends meet.
Ouch, that's gotta hurt.
It does.
And lastly, those delay tactics. What did that look like in practice?
Well, over a third of the companies tried to just delay dealing with the problem, hoping things would magically get better on their own,
Kicking the can down the road.
hoping that somehow they could avoid making those tough choices.
It's like ignoring a toothache, hoping it'll just disappear.
But as we know, usually it just gets worse.
Right, you can only delay the inevitable for so long.
Exactly.
This has been such a thought-provoking deep dive.
I agree.
We've really gone beyond the surface-level understanding of financial distress.
And it's more nuanced than you might think.
Absolutely, there are so many factors at play.
Definitely.
But I think one of the biggest takeaways here is that financial distress, it's not always a death sentence.
Not at all. Especially if a company can address its underlying issues and take decisive action.
And sometimes that action might even involve going through Chapter 11, which, as we've learned, isn't always the scary monster we make it out to be.
It's a tool like any other.
Exactly, and the key is using the right tool at the right time.
Well said.
So keep those minds engaged, keep asking questions, and join us next time for another deep dive.
See you then.